So, as I said, we welcome today. I think our first presenter is going to be Richard Barnes. Are you happy, Richard? Richard's from Towergate, and he's going to be telling you all about insurance and risk for social care providers. I'm pretty sure that you know a lot about it. But, I'm going to hand over to you, Richard. Okay, thank you.
Okay, so now comes the next challenge of working out again how to share a screen. Share screen.
Green button.
Share.
It's coming through.
Slideshow.
Perfect.
Good morning, everyone. Yeah, thanks for giving me the opportunity this morning to talk to you about the fascinating subject of insurance and risk management for social care providers. So this is me. I'm Richard Barnes. I'm Senior Business Development Executive at Towergate. And as I was saying to Karen a second ago, I've been with Towergate since 2008, and my role is looking after a portfolio of clients, exclusively social care providers. That's all I do. So all of my clients either operate care homes, and that could be a single location, up to very large groups, or run domiciliary care agencies. That is all I do. So, introduction. So, Towergate Insurance, we're part of the global Ardonna Group, and we've been providing insurance to the care sector since 1982. I originally worked for a firm called GR Patrick & Co, and Mr. Patrick set up the first care home policy in the specialist care home policy back in 1982, and we were then bought by Towergate when Mr. Patrick decided that he was going to retire to the south of France and develop an absolutely mahogany tan. We recognise the unique and ever-changing nature of the UK care sector. So I think for us, you know, our length of experience in care means that we are uniquely placed to actually understand who you are and what you do. So we've got a team of specialists who focus on the care sector only. So our colleagues work in 3 offices. We've got an office in Bristol, we've got an office in Croydon, and an office in Stevenage. So the care part of Towergate works out of 3 offices. I think we've got over 100 offices for the wider group across the UK. And I think there's around about 200 staff in those 3 offices, looking at all parts of care. And we've worked with Care and Support West for, I'm going to say 10 years, but because we've had a server update, my records don't go back far enough. So I'm convinced it's about 10 years. Myself and David and colleagues have worked together, and it's an excellent relationship, and really enjoy working with providers down in the Bristol area. It's very fruitful relationship, and very educational relationship for me as well. So again, as I was saying, a bit about us. We provide cover for over 1,500 care homes, offices in 3 locations, got an in-house care team, and as well as being brokers to Care and Support West members, we're also brokers to Care England members and the Home Care Association. We work with a couple of other regional associations, but we tend to find they're not really as good as Care and Support West. So we tend to focus on the best regional associations because most of them aren't as good as Care and Support West. So a bit of background, what insurance do you need? So as a care home operator or provider of domiciliary care, what you will find is that most insurers in the UK are simply not interested. You're far too complicated, and the perception is that you have far too many claims, and they're just not interested in getting involved. So what you'll need to do as a provider of social care is work with a specialist broker, work at Towergate, but make sure you're working with a specialist broker who actually understands the social care sector and what is required. We do still find some clients whose policies, when they come to us, we look at their policies, they're just not what they should be. You know, I've seen a client recently who had an office package policy, and that office policy did not cover any work away from the premises. Well, as a domiciliary care provider, the vast majority of your work is away from the premises. So make sure that you're working with a broker who actually understands who you are and what you do. So for most social care providers, there are package policies out there which have been developed, you know, to be a solution. So whether you're operating a care home or running a domiciliary care agency, you do have access to specialist policies. If you're an absolutely massive group, you're much more likely to be splitting up your insurance requirements into its constituent parts. So you'll have a buildings policy, a contents policy, an employer's liability, a medical malpractice policy. But for everyone else, there's a package arrangements are available. Something to be conscious of, which I'm finding more and more at the moment, is liability limits are increasing. So 10 years ago, the standard public liability limit that was requested by local authorities as part of tender arrangements was 5 million. That was then increased to 10 million. And we're beginning this year to start to see local authorities asking their providers as part of tenders to have a £20 million public liability limit. Now, so far, we've pushed back successfully and said, no, we don't provide 20 million, we provide 10 million, and that is more than adequate. At some point, that pushback is not going to be successful, and we're going to be forced to increase our limits. Okay, then the reason for, so why are they asking for such big limits? The reason they're asking for such huge limits is that the councils are renewing their insurance policies on 20 million, and therefore they're expecting all of their contractors, whether it's a care home operator, a domiciliary care provider, or even the bloke who pushes the broom around the car park, who's likely to be self-employed, to all have exactly the same level of cover that the council do. So watch out for that in your tender documents. Historically, in the last 5 years at least, it's always been 10 million. Make sure you're not signing up make sure you're not confirming that you've got 20 million pounds worth of cover when you haven't. Again, speak to your broker. They can push back to the local authority for you. But again, something to very much be aware of. The other thing is, which is important to note, is most of these package policies include additional benefits. Are you aware of all the benefits that are included within your policy? Again, I'm not going to comment on what other policies may or may not include. They're all very similar to ours. But are you aware of the legal expenses cover that's included in your policy? Are you aware of the confidential stress helpline that's available for your staff, etc., etc.? You're paying thousands of pounds a year for your insurance. Make sure that you're wringing make sure you're wringing as much value out of those arrangements as you can, because again, you're paying for it. Make sure you use it. So that's the two main package policies which are provided to, which are there for the benefit of providers. So what else do you need? There's the standard stuff: motor vehicle insurance. If you've got vehicles which are owned by the company, arrange some motor vehicle insurance. Another really important one is management liability cover. Now, this is historically known as directors and officers cover, but more modern name for it is management liability. So if you're a limited company, so let's say you're running Richard Barnes Care Home Limited or Richard Barnes Domiciliary Care Limited, that limited company is a separate legal entity from the directors and employees of the business. If a claim happened to be made against one of the directors or one of the employees of the business personally, let's say allegation of worst case scenario corporate manslaughter, the insurance policy which is there to protect the limited company would not protect the director or officer being any employee in a position of responsibility. What would you do if a claim of corporate manslaughter or something equally as serious was made against you or one of your staff as an individual? Management liability cover. You've then got cyber insurance. Now, as I'm sure we all know, computer crime is absolutely rampant at the moment. I think I've seen various horrific stats showing that over half of UK businesses have suffered a cyber attack in the last 12 months. Again, one of my favourite anecdotes is there's absolutely no point in trying to rob a bank anymore. Don't get your friends together with balaclavas and shotguns and jump in the back of a transit van, because if you head down to the nearest Barclays, you'll probably find it closed 2 years ago. And even if it is open, they don't store any money there anymore. And even if you manage to get hold of some cash with CCTV, DNA, these special inks, etc., you're going to get caught. Far easier to sit at home, send out 100,000 emails a day and get a 1% strike rate. A standard care insurance policy will not protect you against that. A separate cyber policy will. Very, very important. And again, a lot of our clients are now setting up or now buying properties, whether that's to use as staff accommodation. If you're bringing staff in from overseas, very often you have a responsibility to house them, or setting up supported living accommodation, a separate property policy. And then you've got other things. You know, your insurance broker can put you in touch with someone. Again, it needs to be a specialist, because I wouldn't do it personally, but we can put you in touch with people who can do workplace and private pensions arrangements for you. Key man cover. You know, if you're a domiciliary care provider, what would you do if your registered manager was suddenly incapacitated for 6 months? A key man person, I know it's key man, very old-fashioned phrase, but a key man cover will give you compensation if your registered manager or another equally important person was unable to work, and give you compensation to enable you to go and hire someone else without those additional costs to the company. And again, most insurance brokers will offer personal insurance. I think for the likes of you, for the likes of me, with very standard personal insurance arrangements, very standard house and very standard car, I would always suggest that you just go online, and because the availability of online insurance policies is such that you don't need to have an insurance broker necessarily. But if you've got slightly more unusual requirements, or you've got a larger house or more exciting cars, then absolutely there's benefits of working with an insurance broker who can make sure you've got the right cover in place. So as I said, other services that can be offered go as far as the following. Again, Towergate have a dedicated health and protection team who can offer things like pensions, private medical, group life assurance, income protection, etc., etc. One comment that was made to me recently is all UK businesses were required to set up a workplace pension some years ago. When was the last time you reviewed that? I think most providers are still with the same pension company who they were with when they first set up the workplace pension. I've been told there is potential for savings if you review that pension scheme. Maybe worth having a look at that. So, current state of the insurance market. So we are coming out of the pandemic, and you'd like to think that things are settling down. Well, they're beginning to. Things are beginning to settle down, and things are beginning to slowly improve. I was going to say all. 99% of insurance policies continue to have communicable disease restrictions. Okay, so this is not a COVID-19 restriction, because if they simply restricted claims for COVID-19, then when COVID-20 appeared, they'd find themselves on cover again, and insurance companies do not want to get involved in any claims for communicable diseases. It is important to note that, again, 99% of insurance policies continue to provide communicable disease cover for your employees. So if one of your staff catches a communicable disease and holds you as a business responsible, then most insurance policies will still respond. What is now excluded is claims being made by the individuals you're supporting or members of the public. The good news is that in terms of these liability claims, we've seen very, very few. The problem that the insurance industry overall has faced is business interruption claims arising from COVID. Not something they were expecting to see. Clever lawyers looked into the policy wordings, pulled them apart, and insurers have paid out billions of pounds for shops, restaurants, fish and chip shops, etc., who were forced to close as a result of COVID-19. So the insurance industry as a whole globally took a massive hit from that, and that continues to have an impact. So as I say, third point, additional capacity is slowly returning. Most insurers in May 2020 ran 1 million miles from social care and closed their doors. Those insurers are slowly coming back, and they are willing to consider providing quotations. However, they are only prepared to quote for what they consider to be the very reddest and very juiciest cherries. So you need to make sure from our perspective, if we're going to be getting alternatives for you, if you haven't got a good CQC report, it is extremely difficult to persuade a new insurer to provide a quotation. So that additional capacity, they are coming back to the market and they are considering providing quotations, but they are not prepared to get involved in a bidding war. They will provide a quotation, and if they think, if what you've got is cheaper, they will not reduce their premium in an attempt to secure your business. The premium quoted is the premium quoted. So, but at least for me, I can say to my clients, well, here's your premium for this year. I've been out to 2 different insurers, and none of them can compete. Whereas over the pandemic, I didn't have that opportunity. It was, here's your quotation, and there are no alternatives. High levels of inflation continue to result in large index linking uplifts. So what this means is that every year your insurance company will apply index linking. So this is a percentage increase to your buildings sum insured, if you insure buildings, and your content sum insured. If I look back in my little book, back in March 2021, index linking for buildings was 0.52%. So they were recommending that buildings were increased by 0.52% and contents was increased by 0.03%. Very, very small uplifts. If I look at this month, index linking for buildings is 8.3%, and contents, they're recommending that your contents be increased by 12.1%. Okay, still, and that is a massive increase, and that will have an impact on your insurance premiums. So again, be aware of that. Ask your insurance broker, is index linking being applied? But also remember, it is not their responsibility to make sure that your sums insured are adequate. It is your responsibility to make sure that your buildings are adequately insured and that your contents is adequately insured, and also that the annual revenue that you're advising your insurance company remains correct. You do not want to have a large claim and work and then discover that your buildings are not correctly insured or your annual revenue is not correctly insured, because that could have a significant impact on the amount that your insurance company pays out. So this is always a good one. How to secure the best possible renewal terms. So here we go. I mean, ask yourself the question, does your broker actually understand the care sector? Was your insurance broker speaking to a motor trader or a shopkeeper before they spoke to you? There are specialist insurance brokers out there as well as Towergate. Make sure that you're working with someone who understands who you are and what you do. If you don't speak to your insurance broker regularly throughout the year, we would recommend that you start your discussions at least 90 days prior to renewal. This will give your insurance broker and you the opportunity to develop or to produce a set of data to send over to the insurance company to make sure that you can get the best possible quotation. Have a look at your business description. Does it actually cover the full range of activities undertaken? So for example, if you're a domiciliary care agency, does your insurance policy just say domiciliary care agency? Does it actually, are you confident that some of the more unique activities that you would provide to your service users are covered? Does your insurance company know that you're providing tracheotomy care? Do they know that you do peg feeding? Are those things covered? Should be, but maybe if you haven't told them, they don't think you do it. So, if you are doing high-end stuff, make sure you're speaking to your insurance broker and they know what you're doing. Again, for example, from a residential perspective, if you're supporting very complex individuals, does your insurance company know that, or do they just think you're dealing with, in inverted commas, learning disabilities? Talk to your insurance broker about changes which have happened in the year, such as, income, activities, the types of individuals supported. We all know that the sorts of individuals who are remaining in residential are more and more complex. If you are looking to support individuals with much more severe needs, make sure you're speaking to your insurance broker and telling them about it. And again, as well as what's happened in the last 12 months, talk to them about your plans for the future. What you're going to be doing differently in the next 12 months so the insurance policy can keep up. Finally, make sure that your insurance broker is talking to you about any changes being made to the policy wording or additional restrictions that they're looking to apply. Again, with those COVID restrictions which were all put in place, I know most insurance companies are very good at making sure their policyholders are fully aware of what changes are being made, but what other changes are being made. And that's me. I'm Richard Barnes from Towergate Insurance. I think, in summary, speak to your insurance broker, stay in contact with them, and make sure that you, again, do you know who your insurance broker is? A lot of providers don't have a name of someone who they deal with. If you don't have a name of someone who you deal with, I recommend you get one. Don't just deal with a call centre.
Richard, thank you. That for me was amazing. I've written down loads of things here, and I've probably got a few questions. I don't know if anybody else has got questions. Richard's here to answer, so there's nothing in the chat at the moment.
That's fine. I think from an insurance perspective, one of the phrases that I was always told when I started in this industry was, if your clients aren't scared, you're not doing your job properly. My job is to make sure that you are fully aware of the risks that you face, because only you as an organization can mitigate those risks. It's your, unfortunately, you can pay an insurance premium and transfer the risk of something to an insurance company, but it is your business at the end of the day, and you need to make sure that you know what you're spending your money on as well.
Well, that's absolutely true. Rob's asked a question. How many insurance providers are now in the market?
Depends if you're talking about domiciliary or care for residential. Domiciliary is very much made up of brokers. So what brokers will do, they'll have an in-house scheme and they'll have an insurance company that they work with. I'm not aware of any insurance companies who are providing quotations to the general market. So insurance brokers will have a closed scheme that only they can work with. In terms of residential, for property, for care homes, who's currently providing quotations? Well, New India aren't providing quotations anymore. Aviva and Ecclesiastical have come back into the market. They're the two new ones, but Ecclesiastical are only prepared to work with Towergate, and they're only prepared to provide property quotations at the moment. So liability, you can't get that from Ecclesiastical. So an Aviva, Zurich are out there doing little bits and pieces, but Markel at the moment, for most providers, Markel is by far and away the most dominant insurer in the market.
It's interesting. It is interesting.
It's still a handful. It is still a handful of insurance companies.
Which kind of explains why they're also so expensive. I mean, also that and the index linking. I mean, that's a massive jump, isn't it?
Yeah. Well, if you've got a £3 million building, suddenly you're adding on another £300,000.
Yeah, that's a lot of money. I also naively, I guess, hadn't twigged. Your CQC report actually makes a difference on your insurance.
Huge amount.
That is amazing. Yes, it's and common sense says logically, yes, it would do, wouldn't it?
From an insurance company, they've got someone there who is on the ground, doing a lot of their work for them.
That's right.
In a nice concise summary. Well, I was used to say read a summary. They don't even have to read a summary. They can just look at the outstanding, good, requires improvement, or inadequate. And again,
that's enough.
If you do happen to require improvement, you've got an action plan that you produce for the CQC. You can send it off to your insurance company to say, look, these are the measures, or this is the actions that we needed to undertake. As per the attached action plan, we can confirm that we completed all these. Within 3 months of the inspection. Yes, I know it's a year later. They just haven't been out again.
That's right, and sometimes they're not doing. They're not revisiting for 3 years. So it's
risk-based approach. If you just fell below good and you've got requires improvement, again, they may not come out and see you for donkeys.
I was also interested about the cyber side of it, because cyber is becoming one of the things I do, as a lot of people on the call will know, is relating to data security protection toolkit, which is designed to help avoid cyber attacks. And
almost impossible to avoid. You can do everything you can, but
I was going to say
you're in competition with global organised crime gangs.
Absolutely.
Good luck.
Yeah, that's
so
right.
I'm part of the digital social care network. So I don't know if you've come across that, Karen.
Yes, I have.
So I'm part of that. I'm sort of their insurance expert for that, and I'm also part of our Donna's cyber insurance steering group. So I'm sort of sharing information with my colleagues within our Donna. Cyber is a completely separate topic, and I've got my cyber presentation So if you'd like to set up something for members, I can do a presentation on cyber as well.
We can do that, because I know, I mean, we're doing really well in the southwest country with organisations approaching their toolkit and sort of taking notice, but there's still a long way to go. There's still a lot of people that haven't embarked on and registered and completed. It's one more thing. I
still speak to some clients who've got multiple location sites, and they've still got paper accident books.
Absolutely, yeah.
That's
so
not going to be good enough for much longer, I think.
As you say, that's another conversation, and we will take that on board. And lastly, I'd like to say thank you very much for the compliment, Care and Support West.
No, you're really good. No. And again, we get approaches from a lot of regional associations. We don't deal with all of them, shall we say?
Okay, thank you. Well, if you'd like to stop sharing, I will now. And providing nobody has got any questions, I will hand over to Rob Kinsman from Christie's, who's going to talk about what's the care home transaction market. Gosh, that's it's coming through. Do you want to?
Thanks, Karen. You can let me know when the presentation
is there. If you want to do the slideshow, then it'll make it larger. There you go. It's
great.
Right. It's all yours. Over to you.
Thanks, Karen, and thank you, Richard. That was a really interesting presentation. Good morning, everyone. My name's Rob Kinsman. I'm a regional director of Christie & Co. For those of you who don't know about Christie & Co, we are one of the market leaders in the sale and valuation of going concern care homes. We've been aligned with Care and Support West for over 10 years and really value the relationship with Care and Support West. So it's great to be able to talk with you all this morning. I'm just going to talk for 10 or 15 minutes or so, and happy to take questions as we go or afterwards. And I'm going to chat through really the care home market, how it's recovered from the pandemic, and also what's happening now with the increased interest rate environments and inflation. So really focusing on elderly care and the valuation and the transactional market within elderly care. So just a bit, firstly, I guess, about how the market has been in the pandemic. So obviously occupancy suffered hugely with COVID. And the brakes were put on most of the transactions. So what we found was in 2020 and 2021, buyers and lenders definitely sat on their hands, and transactional activity really paused. But since then, since the market has opened up and occupancy levels have recovered, we've seen a real rebound in activity levels. And healthcare, I think it's worth noting, is definitely seen as a secure, needs-driven investment, and it's seen as quite a defensive sector to be involved with by investors, especially when compared with high street retail, shopping centres and offices that really have seen a huge hit in terms of occupancy and values. And we've really not seen that in the healthcare sector because it is needs driven. And obviously it does have its challenges, but banks are still willing to lend in the sector. And we're seeing, a lot of investment and operators wanting to expand their portfolios. So it's not all bad news. Moving on to, I guess, the Southwest market. There's about 48,000 care home beds in the Southwest. It's about 10% of the total UK stock. Interestingly, about 40% of the care homes in the Southwest are conversions of one sort or another, and that's the highest percentage in the UK. So there's more converted care homes in the Southwest than the rest of the UK. And interestingly, over 82% of the stock in the Southwest is over 20 years old. So I think we do have a challenge over the next decade or so on how we provide more environmentally friendly care homes and aligning with ESG strategies, and how we can make our homes more efficient, because over 80% of them are, older stock. So we've got a really good compliance rate within the Southwest, 87% compliant when compared with 78% across the whole of England. We've got a lot of charities, nearly 20% of care homes in the Southwest are non-for-profits. And we're seeing that market really challenged at the moment. And we're seeing a number of non-for-profits looking to exit the sector, which is very sad, as they're suffering from really very high staff costs and utility bills, and have not managed to really control those when compared to more commercially minded operators. So I'm just going to move the slide on here. You can see the map there that shows the care homes throughout the Southwest, and then the next map I'm going to click on now shows the sales that we've concluded in the Southwest over the last few years. So the market has certainly rebounded, and we're seeing a good level of activity. And I'm now going to just, I guess, dive into that in a bit more detail. I think one of the factors that we are seeing post-pandemic, with the higher costs in utilities, inflation, and higher interest rates now, is we're seeing an increased level of care home closures. And this slide shows that since 2015, there's been 2,322 care homes that have deregistered, and we've only seen 1,897 new registrations. So we've seen a net loss in care home beds over that period. So in the first time in a long while last year, we saw a net loss in care home beds on an annual basis. So, in the last decade, the population over 65 has grown by 19%, and yet we've seen a net loss of bed spaces. So, we're storing up a big issue in how we're going to look after our elderly population over the next, generation or so. In the Southwest, we've seen nearly 2% of the bed stock deregister in the last year, which is concerning, and we've lost around 1,800 beds in the Southwest in the last 5 years or so. So it is an issue, and as you'll see on this slide here, a lot of those, not all of them, but a lot of them are smaller care homes that have been unable to cope with the higher cost base and squeezing margins, and they've simply not got the economies of scale in the current environment to be economically viable, which is a real shame, and it's an issue for the sector and our society as a whole. You can see there the characteristics of the new builds coming on stream, average size of 71 beds, and that compares with the average size of 32 beds for those that are closing. So there is an issue there in terms of closures, which we have to address. I'm just now going to just talk about, I guess, the level of instructions that we've received as a company in the last few years. You'll see there that in going into 2020, we saw a huge drop off in new instructions come to the market. And that's obvious because obviously providers were looking to cope with the pandemic. And then since then, we've seen a big increase in instruction levels. So this is care home owners coming to Christian to sell their businesses. And we saw a 53% increase moving from 21 to 22. And we've really seen a very buoyant market with low interest rates, and owners, after a very difficult time, looking to retire and exit the market as their businesses have recovered and showing long-term profit advantage with the increasing occupancy. So we've seen the market return to some sort of normality with instructions increasing. And this slide shows really the number of offers in terms of volume and value that we've seen in the last few years. And again, this is no surprise here. You'll see a huge drop in care home offers and the value of offers in 2020 in the peak of the pandemic. Although it is interesting, we still sold 154 care homes in 2020 in the peak of the pandemic, which was more businesses than we sold in all our other sectors that Christian are involved with. So that's pubs and hotels and restaurants and the like. And I think that just shows that the care home sector has remained relatively resilient and is still seen as a good investment from many UK and international investors as well. So last year, 38% of the capital that was invested in the social care sector was from abroad. And we're seeing that trend increase as foreign investors like the fact that we've obviously got an aging population and strong underlying property values. And the care home sector very much fits with large funds, ESG That's environmental, social, and governance credentials. So we're seeing a lot of investment in future-proof care homes that definitely fit the bill for larger corporates and their sustainability targets. This next slide shows how we've sold the care homes in terms of actual price agreed versus the asking price. And you'll see in 2019, we concluded deals at about 95% of asking price. And then that nudged forward to 98% in 2020. But actually last year, on average, we exceeded our asking prices, achieving 101%. And I think that just shows the rebound and the pent-up demand following the pandemic. And there was more deals done on a cash basis and a lot of operators seeking to expand their portfolios and take advantage of the instructions that we were receiving. This is an interesting slide, and it just shows where our buyers are coming from and how far away they're looking from where they live to the actual care home they're purchasing. And you'll see in 2015, 50% of our deals were completed to buyers that live within 50 miles of the target business. And in the same year, 29% of the deals were done to buyers that lived over 100 miles away. And then in 2022, we saw a lot more buyers looking further afield. 48% of our deals last year were done to buyers that lived over 100 miles away from the care home that they were looking to acquire. There could be many reasons for that. I think that the market was good. I think technology has definitely helped providers be comfortable that they can maybe own care homes from further afield. Clearly, they need to be hands-on as well, but we are seeing more flexibility in where buyers are looking, and I think technology is a big driver with that. This next slide just outlines, I guess, the type of buyers that we've got in our sectors. So you'll see from the slide there, in 2018, 16% of our deals were to new entrants, first-time buyers in the sector, and that's dropped to around 7% last year, which is a sort of worrying trend. We do need newcomers coming into the sector, and I think that just reflects probably the tightening of the lending market last year, increasing interest rates and ongoing regulatory challenges. It's not easy re-registering with CQC. We're seeing more share deals now as opposed to asset deals, but I think it is more challenging for new entrants to come into the sector at the moment, and that's borne out by the proportion of deals we're doing to new entrants. Last year, we saw a big increase in the corporates and the funds purchasing and expanding. I think over the pandemic in 2020 and 2021, they were very inward looking and obviously looking to sort out obviously their staffing and looking to refurb and working through the pandemic. And last year, their occupancy rebuilt, and they definitely got on the acquisition trail again. And you can see there that 33% of our deals last year were to international funds and larger corporates, and that probably reflects the fact that we're dealing with slightly better quality care homes that we're launching to the market, and they appeal to the larger corporates. But our most active group is the independents, those local providers that own 1 to 3 care homes that can tap into that local market, understand the relationship with the commissioners and referring authorities, and they made up sort of 33% of the deals last year together with the regional multiples. So it's a broad range of buyer types, and we'll probably see that continuing this year as well. Just touching on closed care home deals, we have seen an increase in closed care homes, as I mentioned earlier. Interestingly, those care homes that we do sell on a closed basis, most of those closed care homes go back into the social care sector. So last year, 80%, you can see the chart on the right there from 2022, 80% of the deals we did on closed care homes were to buyers that were looking to reopen that property either as elderly, specialist, or support and convert to supported living. So that's really very encouraging. 2021 actually saw a record number of closed care home sales. 31% of the deals we did in 2021 were on a closed basis. 56% of those were to care home buyers, and that increased to 80% last year. So, we do deal with a lot of closed care homes, unfortunately, but most of those do get repurposed for the sector, which is encouraging. I'm just going to finish off with some local sales that we've handled fairly recently. We sold Grove Care in Bristol last year, 4 care homes across 2 locations in Patchway and Winterbourne, 3 purpose-built assets with wet rooms, really well-run business, 2 outstanding rated and 2 good rated, and we sold that to Allegra Care. That was a sort of confidential off-market process. We got a lot of interest from the national corporate providers, and in the end it sold to Allegra Care, who are an expanding sort of regional provider. I think they've got 12 care homes now, and they're backed by a private equity group called Moorfield. We sold and completed on Annabelle House last week in Weston-super-Mare. This was sold to a provider that owns 1 care home in Weston-super-Mare. So this was their second purchase. It was backed by Metro Bank, off an asking price of 1.5 million, good average fees, a really well-run care home, and a good example of how actually those converted care homes still are in demand and still can work really well. So that was sold to a local buyer that's looking to expand. And last but not least, we sold Faith House a couple of years ago, and I wanted to give a range of the size of care homes we're selling. This is a small care home in Severn Beach. It was owner operated prior by our clients, and this was sold to a new entrant that lives in Bristol. They've made a really good success of the business, and they're looking now to purchase their second care home. They live locally, they're funded by Atom Bank, and are looking to expand. So there's 3 sort of a range of sales that you can see sort of demonstrated in the market, and how there's an appetite for all types of care home, really. So that wraps up my presentation. I wanted to keep it to about 15 minutes, so hopefully keeps everyone's attention, but happy to answer any questions.
Thank you, Rob. That was quite amazing, actually. I think it's quite encouraging to know that the care sector is still quite buoyant in the market. It's a shame, isn't it, that there's a low percentage of new people coming into purchasing. That's quite telling, I think. But then that also explains it's really hard if you haven't got any previous experience for funding and things like that. It's very difficult to get the funding. Does anybody have any questions? There's nothing on the chat, but if anybody would like to open up and ask any questions, we still have Richard also on. So Lucy, do you have a lot coming in that can be converted to supported living homes? So that's Lucy, I guess you're asking, do you have a lot of properties coming in that can be converted?
Yes, we do, Lucy, actually. And historically, I think a lot of older care homes that closed would be suitable for conversion. But I think what we're finding now is supported living providers, much like the care home market, the requirements have shifted. And instead of having like an HMO style property, supported living providers definitely want more apartment type accommodation, where their clients can have independent living. So you've got kitchenette, kitchen, toilet facilities. And so converting an older care home is now very difficult, because it doesn't necessarily provide apartments, which is very much what people are looking for. So I think people are looking definitely now to build new from scratch if they can for supported living, and conversion is becoming more difficult.
I mean, one of your slides shows that 87% are CQC compliant, and I guess from that you're meaning to do with the bedrooms being with en suites, that sort of thing. Is that what you're referring to?
Sorry if that wasn't clear, actually, Karen. That was good or outstanding. So
okay.
Good or outstanding in the Southwest, which is higher than the national average.
Oh, I see. Well, that's good to know. Well done, Southwest.
Thanks.
Sorry, Lucy.
Thank you for answering that.
Okay.
No.
Does anybody have any other questions?
I think Josh has raised his hand.
Oh, I can't see that, sorry.
That's okay.
Hi, Rob. Thanks for that. That's really good presentation, really interesting. There's a couple of things. One's just an observation, really, that a new build, you're saying that the average scale is 71 beds, which seems huge, given the increased costs of builds, I would imagine, is going up and up and up. So in order to facilitate that, you're then going to have to replicate a huge level of fee income to be able to facilitate on that sort of scale. And I'd imagine also in terms of the difficulty around staffing, that as a smaller operator we find on 30 to 40 beds, scaling that up to 70 plus beds must be really, really difficult to be able to do that. And whether it then sucks the workforce from the surrounding area, or whether they're getting more and more staff through immigration to be able to supplant that. I struggle to see the sustainability on that sort of scale, with all those kind of market forces that are kind of pulling and pushing against each other. But it's just interesting that new builds are on such a large scale, given those sorts of costs. The other thing I was just wondering, as always, is with the market moving, and interesting that last year the asking prices are over. You're getting more than the asking price. How's that affecting kind of the average, especially in the region, your multiples, and whether they're stabilizing, whether they're increasing, and on what kind of level we're looking at?
Thanks, Josh. I think you summed up in the first part your observations, the challenges the social care sector's got. I think the build costs now, we've got an aging stock in the UK. We've got forecasted 200,000 bed space shortfall in 2050. Yet we're not building enough care homes, and the cost of the build is just astronomical. It used to be 10 years ago it was 50,000-60,000 pounds a bed. Now it's 150,000 pounds per bed. That's after you've acquired the site, and then obviously you've got a period of build up as well. So there is a real issue in terms of the economic viability of these new builds. And that's why, of course, they're only really being built in areas where operators can focus on the self-funded market. And that, of course, doesn't cover the whole market at all. And so we've got lots of areas in the UK that really are seeing no new build activity, because it costs the same to build a care home in an area with no self-funders than it does in a more affluent area. So that is a real issue. And of course, the staffing of those care homes is a big problem as well. And I just think, the care home providers that I speak with, those that have got the foreign sponsorship license are able to, recruit more effectively by bringing staff in from abroad, which is, what needs to be done. And, I think those larger providers are definitely finding the recruitment more challenging, because, as you say, if you've got an 80-bed care home, you've got a larger staff team, and if you're starting from scratch, quite often what happens, as you say, is the staff are attracted by local providers, and that's more competition for you. So that is a challenge for sure. In terms of the asking prices last year, I think those numbers reflect in the main the mini budget deals. So I think the multiples in the market last year had not changed. And I don't actually think, Josh, we're going to see multiples this year change. But I think what we're seeing is, in many instances, margins are being squeezed and profits aren't moving forward in care homes in the way that they have done necessarily. So if we're selling a business and it's got a slightly lower profit than it had a couple of years ago, and you're applying the same multiple, then values might soften a little bit, because we're looking at a multiple of profit for the value. If the profits have moved forward, actually, there's no reason why actually we wouldn't be able to achieve a slightly higher value. So it really is down to the individual business. But the higher debt costs is definitely feeding into deals at the moment, and obviously you've got higher utility bills as well. But fundamentally, we still got a lack of supply in the market, and whilst demand is still good and there's a relative lack of supply, then that helps hold up values as well.
Yeah.
Yeah, interesting. You go back also to, especially with older stock, where you've got buildings that do need, energy efficiency measures that, yes, there was money actually from North Somerset to be able to facilitate the development of a better energy efficient care home, but it still costs a huge amount of money in order to, especially older homes, cavity walls, insulation, all of those, that there was money available, but you do have to outlay. And it was, when you survey, it's tens of thousands of pounds that you then have to balance up, the accessibility to ready cash to be able to do that, to then have an energy efficiency saving 10, 15, 20 years down the line is very difficult. But you do need to do that, and as we will find that, especially if you come to sell, that will be more and more. We've got it within residential properties. You'll have it in commercial properties as well, that you look at that energy efficiency, and I imagine that will have an effect. But it still costs, and you have to kind of balance that up of, is it worth it? Can you find that extra cash, or does that cash need to go into other means of capital purchase, especially with old stock, where we know that old buildings take a huge amount of cost just to have upkeep. You will always find things with older buildings rather than with newer buildings. They're made to spec, and it's much easier in terms of maintenance than older.
Absolutely. I think we need more creative approach from the government, more creative grants to bring older properties, into a state where they are more energy efficient. I read yesterday that Abbeyfield are closing 40 properties, citing the long-term energy compliance that they've got to try and meet, and it's just simply not sustainable. Last year, one of the largest UK healthcare REITs refinanced with Aviva, and the sort of rates were linked with the improvement of the EPC ratings, and on the new developments on really outstanding BREEAM ratings in their new properties. So we're seeing it at the sort of corporate level, beginning to see financing linked with ESG and the environmental sustainability and efficiency of the buildings. And as you say, it will filter down in time.
Yeah. Rob, John's asked a question. John, would you like to open up and ask the question, or?
Yeah, happy to. I mean, this is a bit of a crystal ball question, but yeah, what are your thoughts on building costs, and whether they would, can they continue inflating so quickly, so much? Could they even be a sort of retreat a bit because they've inflated so much over the last 5-10 years? Do you have any thoughts on that?
Thanks, John. Anecdotally, we're seeing the pace of increases slow. So we are seeing, I've heard from some developers that the rate of increase is slowing. So I see that inflation in, I guess, the supply chain in many respects is easing up. So I would say, yes, we're going to see a slow in the rate of those costs increasing and plateau. Whether we actually see them decrease or not, I just, my view would be probably not. Do you ever see prices actually come down? It's very rare, isn't it? But I do think we will see, prices plateau. And ultimately what we need is, fees to make, new builds commercially viable. And that's down to obviously government funding.
That's right.
Thank you.
Mortgage rates then will have an impact as well, won't it? Bank of England, how they respond and what they do will have a big impact on all of it. Yeah. I think it's interesting that the people purchasing so far away, it seems to me is sort of squeezing the smaller person out, which is a shame, I believe, because I think you have that personal touch on social care. If they become too big, there is a question. But then technology, as you quite rightly said, helps progression, and we just need more beds, don't we? So
yeah, absolutely, it's the biggest challenge we face.
Thank you very much, Rob, for your presentation. Does anybody have any more questions for either Rob or Richard, who's still with us? If not, I'm going to bring we were planning on running this until 11:30, but in view of the fact that Guy's not with us, I will let you have some of your day back, and which I'm sure will be appreciated. I think today's presentations has been really, really interesting, very useful. It's good to see what's happening. It's good to understand both presentations. Has brought a lot to the table for, hopefully, for our people who are joining us today to take away and think about. I'm going to stop sharing now. It's not going to be